Good afternoon and welcome to the Morrows Monthly update for June. Markets have been resilient over recent months, with global equity markets continuing to push through record highs and volatility at lows not seen since 2007. That being said, there is still a sense of caution, and geopolitical risks in the Middle East remain elevated. The Australian equity market was lower by around 1.5% in June, and global equities were mixed. Europe was marginally lower, China was flat, the US was up 2%, and Japan traded up 3% for the month. Global bond yields continued their decline throughout June. However, the benchmark 10-year Treasury yield moved higher to 2.53%. Yields in peripheral Europe also continued their decline, with some countries reaching record lows. Commodities were generally higher, with oil prices up 3% and gold up 6% for the month. However, iron ore prices continued their decline, down around 5%. The US dollar was flat against the euro and marginally weaker against the yen and the pound. The Aussie dollar traded higher by around 1% against the US dollar and was flat against the other major currencies. US economic data was mixed in June. Both the manufacturing and services sectors were stronger than expected, and industrial production also picked up. The unemployment rate was flat at 6.3%, but retail sales missed expectations. Final first quarter GDP growth was revised sharply lower at -2.9%, but much of this was attributed to bad weather. The US Federal Reserve also tapered its stimulus program by a further $10 billion during the month. Economic data in Europe was also mixed. The manufacturing sector fell, but industrial production picked up. The unemployment rate fell to 11.7%, and inflation came in lower at 0.5% year on year, much below the ECB's desired level. In response, the ECB cut interest rates to a record low and stands ready to act if further measures are required. Data out of China was generally positive, with the manufacturing sectors and the services sector both up. Retail sales, trade data and industrial production were also strong, and inflation fell to an 18-month low. In Australia, both the manufacturing and services sectors picked up but remain in contractionary territory. Consumer sentiment and retail sales were marginally stronger, and the unemployment rate was flat at 5.8%. The 2014 financial year is now behind us, and it was generally a good one for investors. The back end of 2013 was very strong. However, the last 6 months, markets have found a lot more challenging to move higher with any real momentum. As we look forward, the landscape is mixed. We're in a low interest rate environment and central banks remain accommodative, and this is positive for markets. However, geopolitical risks remain elevated and investors seem to have moved to the sidelines, which has been seen in very low trading volumes. Focus will now shift to the US corporate earnings season. With markets pushing through record highs, we really need to see strong corporate earnings growth to justify the current valuations. In the absence of this, markets are likely to find it very difficult to move higher in the short to medium term. Our portfolio strategy remains the same, and we continue to focus on managing risk. We would also caution investors against becoming too complacent in the current environment, which has been masked by extremely low volatility. We thank you for taking the time to listen to this update, and we look forward to talking to you again next month.